Hello. Well, this week price has improved much more than the score of the risk model. Spreads are still negative. I haven't run this, it's early on Friday. It will have improved no doubt slightly, but it's still nowhere near a positive score and therefore not enough to generate a buy signal. As I've written in all the daily commentaries, this is now where we fight the battle between the bulls and the bears, and I will go through the exact levels in a moment, but it promises to be a very, very exciting couple of weeks ahead with what the market has done this week. At these times of uncertainty and volatility, it's always useful to go and have a look at the fundamentals and the blue angels. We are now crossing well over the times 15 blue angel on a very descending path. The 200-day moving average is at the moment actually not very far from the times 16 blue angel, around the 2770 area. And it is not completely excluded that we go and test it, just as we did here when we touched the times 16 and went sideways for a long time. It is a possibility, although 2725 remains my favorite, and I will show you why later. But just so that you get the picture, price is the price of the blue angels is declining. It is just not declining as fast as the market had wrongly interpreted to be when it did this in December. That was sheer panic. I never thought that it would get through the times 15. It has. You have to amend your views as facts change, and we will have a look at what is likely to happen. Maybe something like this here, or like this here. We will go through the various scenarios and establish some odds for them, and then decide what the best course of action is. Well, in the bonds we got it nearly spot on. We said that we'd like to see this retracement towards the 267 area, and this is precisely what we're getting. If we enlarge this, we will see that 267, 268 is where the Bollinger Bands come in. We are likely to go there sometime next week and test that area. I think it'll hold just below 270 and establish a top, and then start its move back down. If we have a look at the 10-year note, we said that this is this area here around the 285 area should trade, and that is exactly where we're going. The yield curve is steepening very nicely. That is what we think is going to happen and continue to happen. And here we have IEF, where we basically said that the area around 103 should trade, just maybe slightly lower, trade a while here, and then start the move back up. That is the area where around the 102.50 to 103, where you want to start building some long positions in the IEF and 5 years. TLT we are much less bullish of. We think there's a decent possibility that we go back down towards the 116, 117 area. Just not something that we feel very comfortable holding at the very long end. We have an incredible amount of issuance coming up in the next few weeks. We think it's far more likely that TLT lags. If growth were to pick up in the slightest, probably so would inflation with the tighter situation that you have in the economy, and with the Fed on hold and certainly not wishing to raise more than once, maximum twice, it is likely actually that any kind of acceleration of the economy will produce a steeper yield curve whatever happens. And certainly if a recession is to happen, the yield curve would steepen all by itself. And therefore the steepening of the yield curve is probably the theme for 2019. We think it's the one that has the most odds of success at the moment, because whatever scenario we pick, the yield curve steepens. The only scenario that we can possibly imagine where the yield curve doesn't steepen is one where the Fed does something silly and equities completely crash. And we think that at the moment is probably the least likely of all. The steepening in the yield curve and the 10 years going down is actually giving you a firmness in the dollar which should last some time, because we are going back to this minus 258 basis points. Having tried to go through the upside, failed, we should retest the minus 258, minus 259 basis points, and that should keep the dollar relatively firm. We'll have a look at the dollar in a moment, but this is basically what we're looking for. We're probably looking for a return to 96.50 in the DXY in the next few days. Before we leave the bonds, I wanted to show you something interesting, which is the objective from this pattern as an ABC. We're looking basically for 286 to 87, possibly as high as the 200-day moving average at 294. This is the area where we think this bond market yield rally is going to stop, between 286 and 294, and that basically equates to 120 and a half to 120.04 in the futures. That is the area where we can take a real stab at risk off. Passing on to equities, and here we are on the monthlies. We are going to be testing this red line, which is at 26.90. Amazing how the market is responding. Basically touched beautifully the Bollinger Band, straight up onto this exponential moving average, with the next one coming in at around 27.40. This is the area that we will battle out in the next few weeks. And if we go down onto the weekly now, we will see that basically we have a lot of matches. Here is the weekly. If we actually enlarge it, here we are, touching it almost at 26.75, and then the next ones come in at 27.10 to 27.25. 27.25 is, as you will recall, the level last year that traded the most volume. It will be very interesting to see what happens there. That is, my first objective is this red line, which is 28.80, call it. I calculated 27.77, but no matter. And then 27.25 next week. 27.25 is going to be really, really interesting, and I hope that we match 27.25 together with what I've just shown you in the 10-year note. I prefer to go by the bonds rather than by the equities. Whenever bonds reach those levels that I told you about, which is just below 120.16, that will be a very interesting time to try risk off. Until then, there's no point. It's still risk on. Still safe to be long, still going up there. If we actually now look at the Dow has got a beautiful weekly line here at 24,900. 24,900 is a beautiful level to do some options. 24,950, whatever it is, absolutely beautiful. That is where the market should stop, around 24,950 to 24,000 to 25,000. absolutely beautiful level to even sideways. If you look at where the action was, whatever you do here, you won't lose much money. Wanted to show you the yen simply because we are in risk on at the moment. Tactically, it's basically going to 111, isn't it? That's where that's another thing together with bonds, when we can say when it's got to 111, basically we should be getting ready for risk off phase again. If we look at the DXY, it is now about ready to go and test 96.50. It traded beautifully last week off our level, which was 95.07, and now we are back up towards 96.50. That is where we think it'll probably stop for breath before it decides what next to do. But that's important. We caught this whole move, and if we have a look actually at sterling, this is the one that we still think is exciting, simply because we don't see any other possibility at the moment but to have a decent rally in sterling. And sterling a lot of the time trades together with the dollar, so it's very oversold now. Caught most of this move. Now it's going to go back up towards the 89 level. Any move back up towards 89, it's a sell, and we still think that it comes way down, probably down towards the 84 level at some stage when the Brexit stuff has been sorted. The risk-rewarding cable on any bounce up to 89 is very much to the downside, for 5% down to 84. We still like the Nikkei for the very simple reason that the yen is going to be weak for another couple of percentage points. We can easily see it come up towards the 22,000 area. It's now 21,000, that's another 5%. Well, that is certainly going to outperform the S&Ps from this point on. If they have 3% in it, we think Nikkei has 5% at the same time. And actually, because of the strong dollar, we have no problem even buying DAX on dips. As we said, the DAX is the kind of market that you can't really be long of it against anything else, because it's the whole of Europe is very weak, but because it's done so much work, we can easily see it back up towards this 11,600, 11,700 area. And you remember that 11,800 was the level that I really wanted to do some puts in the DAX. Well, this could easily be that try that we're going to go up towards the 11,800 level to then have another leg lower in the DAX. If we look at it on a weekly chart and we enlarge, certainly think that any kind of trade up to 11,700, 11,800, which is basically this level, 11,730 in the next couple of weeks, is going to be a very interesting level to do something in the European markets. Let everybody cover. There is no problem with it. Let them pay up. We'll get involved at our levels. Exactly the same thing with the stocks. The stocks, I think, will trade now somewhere around here, 3,210, 3,220. So they have another 80, 90 points. That's another 3%. That's going to be a very good level to let some go up there and look for a move back down towards 3,000. That's what I expect. Please make note of that level. It's going to be very interesting to see what happens there. 3,220 in the next couple of weeks is going to be a very exciting level to short. And here we are with the biases for next week. What did we say? We got this right. 267 is the level in the 5-year. Well, now we're saying 120.17 to 120.04 in the 10-year is the major level where we can actually try and hope to get some symmetry with that and the equities, and try a serious stab at risk off. SPX got it completely wrong. 2560, 2660, absolutely not. 2677 is the major level, and I'm filming this with another 3 hours to go on Friday, and the high is 2676.5. So definitely got that level right. And 2725 is the other level. 2725 looks like it will match with this level because we're still best part of a point away from this kind of area in the 10-year notes. So I would have thought that another 2% in the S&Ps is likely to match this with that. If it goes through there on closing basis, on a couple of closing bases, then we really have to reevaluate everything, because we're major league wrong in everything. NQ, I still don't like it because it's lost all leadership. It's keeping up with the S&Ps, but last year when S&Ps were up 0.5%, the NQ was up 1%, 1.5%, and that is the kind of ratio you should be having with those high beta stocks in the NQ. At the moment, all they're doing is retracing on a par with S&Ps. Well, in which case you might as well trade the S&Ps on the upside, because it's much less risky. So we're always looking for risk reward. That means that you trade SPX, you don't trade NQ. VX, well, we got that one right, but it didn't help us get this right. 1650 is still the major level, and we think we will get the trifecta, the 1650, the 2725, and the 120.1704. If we get those three aligned, that will definitely be the time to try risk off. European equities, I gave you the levels that I think are right. I still can't see them being of outperformance, certainly not to the Nikkei or to the EEM on the upside. Therefore, I only see the point of trading them to the downside when everybody is covered like crazy. I gave you the levels that I think we could easily get to in both DAX and in Stocks 50, and those will be the levels that we will trade. Now the dollar, 95.07 was the level it traded. It went through by 3 ticks and straight back up to 96.50, which is the big level. 96.50, as you know, it's been there for weeks and weeks and months, is the really important level, and I think it will not break by more than 10 or 20 ticks. It'll hold for the time being, which basically means that there is no tailwind for SPX at the moment. The dollar remains strong, and we won't have too much tailwind for the SPX. 93.63 is still the very important level to the downside. I don't think we will see it for a long time, and therefore there is not a lot to be worried about there. Let's reevaluate that level when and if it gets there. But you have all the important levels in everything, just not in cable. We can add, in Euro USD, we can add that, in Euro GBP. Euro GBP, we're looking for that 83 to 84 area to trade after we have been to 89. 89 is going to be a very interesting level to short, and Euro GBP, we're looking for 83, 84 after that. Thank you very much indeed, and tweet you on Monday.